Good morning and welcome to your daily solo 401k webinar and Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic is regarding self-directed IRAs. Can I cash out my self-directed IRA? So as always, this is your chance to get answers. Go ahead and type over your questions during the live webinar. They can be surrounding any topic regarding solo 401ks and even self-directed IRAs. So go ahead and use the chat to type over your questions so that we can be sure to get to them all. I don't see any questions at the moment. So let's continue with today's topic for now. We'll monitor the chat. So let's talk about how self-directed IRA distributions work. So if you have a self-directed IRA, which allows for investing in alternative investments like real estate, cryptocurrency, precious metals, tax liens, promissory notes, private equity, the list goes on. You may be wondering, can I cash out my self-directed IRA? The short answer is yes, but it can certainly be very expensive. Therefore, before withdrawing funds from your self-directed IRA, it's critical to understand the IRA distribution rules, the tax consequences, penalties, and understand that there are smarter alternatives that may preserve your retirement savings. So let's talk about the IRA distribution basics. So a self-directed IRA follows the same distribution rules as any other IRA. The IRS does not treat alternative assets differently when it comes to withdrawals. At age 59 and a half, there's a key threshold. So if you are age 59 and a half or older, you can take a distribution without paying a 10% early withdrawal penalty. If you are under age 59 and a half, distributions are going to be subject to one, ordinary income tax on a traditional IRA, plus a 10% early distribution penalty. So if you're age 59 and a half or older, the 10% penalty will not apply, but it is going to be taxable at ordinary income tax rates if we're talking about a self-directed traditional IRA. We'll shed some light on the self-directed Roth IRA in a few minutes. So there are limited exceptions when making distributions from any type of IRA, whether a self-directed IRA or a non-self-directed IRA. Some of those exceptions when it comes to making distributions are disability, certain medical expenses, first-time home purchase for IRAs, etc. But most distributions before 59 and a half trigger penalties. We're talking about the 10% penalty. Now, you can also make in-kind distributions from a self-directed IRA. As I mentioned earlier, a self-directed IRA allows for investing in alternative investments, and one of those common investments are real estate, even cryptocurrency. So if your self-directed IRA holds alternative investments like real estate, cryptocurrency, and so forth, you do not have to sell the asset to take a distribution. You can actually process an in-kind distribution sometimes called an inline distribution, meaning that the asset is assigned from the self-directed IRA to your name personally. Of course, the distribution is going to be reported at fair market value on the date of the transfer. So for example, let's say you own cryptocurrency in your self-directed IRA, and cryptocurrency has taken a pounding and has lost its market value considerably compared to last year. So you could distribute that cryptocurrency in kind to your own personal name, and you would pay taxes on that lower market value of that cryptocurrency. Same thing with real estate. If you want to distribute a property owned by your self-directed IRA, it's got to be done at fair market value, so you'll need to get an appraisal. And if the property has gone down considerably due to adverse market conditions, then your tax implications are going to be lower because you're going to pay a lower tax on that value of that real estate. Of course, on the other end of the spectrum, if that property has accumulated in value tremendously since it was initially purchased through your self-directed IRA, and you distribute that property in kind in your name, you're going to have to pay higher taxes because it has to be distributed and taxed at fair market value. So again, taxes apply based on the value of that asset. And if we're talking about a pre-tax IRA, such as a traditional IRA, then taxes are going to apply. So let's use an example again. If your IRA owns a rental property valued at $300,000 and you distribute that property out of the self-directed IRA, then $300,000 is reported as taxable income since it's inside a self-directed traditional IRA. And if you're under age 59 and a half, there's going to be a 10% penalty that will apply as well. However, if you're over age 59 and a half, the 10% penalty does not apply, but income taxes still apply. Okay, let's talk about Roth IRA qualified distributions. So, and one way to do that is to compare a distribution from a traditional IRA versus a distribution from a Roth IRA. So traditional IRA distributions are taxed as ordinary income. So federal income tax applies. State income tax may apply depending on your state of residence. A 10% early withdrawal penalty applies if under 59 and a half, unless an exception applies. Whereas with the Roth IRA, distributions may be tax-free, but only if they are considered qualified Roth IRA distributions. To qualify, you must meet both requirements. That is, the Roth IRA has been open for at least 5 years, and you are age 59 and a half or older. Now, one item to understand there is that this qualified Roth IRA distribution rule applies to your first Roth IRA. For example, let's say you opened up a Roth IRA back in 1998 when Roth IRAs first became available. And let's say that you ended up closing that Roth IRA a couple of years later. So you opened the Roth IRA in 1998, and then you closed it in the year 2000. Let's fast forward and say that you open up a Roth IRA now, or let's say you opened it up a couple of years ago, and now you want to take a Roth IRA distribution. Well, the good news is that that 5-year clock applies all the way back to when you first opened up your first Roth IRA back in 1998. So as long as you're age 59 and a half now, when you make that distribution from that Roth IRA, you're going to get to use that 5-year clock that first applied back in 1998. So in short, that 5-year clock starts when you first open that Roth IRA, and it continues indefinitely, even if you close that first Roth IRA and later open up another IRA. So if both conditions are met, that means you've had a Roth IRA, whether one now or one previously, for 5 years, and you're age 59 and a half or older, then it's going to be a tax-free distribution. And of course, a 10% early distribution penalty will not apply either because you're over age 59 and a half. On the other hand, if you've never had a Roth IRA for 5 years and you take a distribution before age 59 and a half, then the earnings on that Roth IRA will be taxable. And of course, the 10% penalty would apply if you're under age 59 and a half. But that's only if we're talking about the earnings on that Roth IRA. So remember, Roth IRAs have their own distribution order rules. Let's go over those rules here. So the IRS applies Roth IRA withdrawals in the following order. Regular contributions, those are always tax-free and penalty-free. Conversions, let's say you converted a traditional IRA to the Roth IRA. So penalty rules depend on timing. As far as earnings, they're going to be taxable and potentially penalized if not qualified. That means you haven't had a Roth IRA or a Roth IRA for at least 5 years, and you're also not over age 59 and a half, so you have to meet both. So this ordering rule often allows Roth IRA owners to access contributions without triggering taxes, and many times you'll hear financial advisors advising their Roth IRA clients that they can use their Roth IRA as an emergency savings account because you can always distribute those contributions that you make to that Roth IRA due to the Roth IRA order rules, and you can distribute the basis tax and penalty free. Now let's talk about taxes. That's always a fun topic, as well as reporting. So federal and state taxes on IRA distributions. And here we're talking about traditional IRAs. So IRA distributions are subject to federal income tax, possibly state income tax, and of course that 10% early distribution penalty if under age 59 and a half. So if you take a distribution from your self-directed IRA, whether you're distributing cash or an asset, that self-directed IRA custodian has to report that distribution to the IRS. And they do so by issuing Form 1099-R, and they have to use special codes when reporting that distribution. So if you take a distribution from your traditional IRA, and if you're under age 59 and a half, then that custodian is going to use a code 1, which is the early distribution code for someone who takes a distribution from a traditional IRA when they're under age 59 and a half. And that's how the IRS knows that it's not only subject to income taxes, but also a 10% early distribution penalty on top of that. On the other hand, that Form 1099-R will have a code 7 instead on that Form 1099-R if you make that distribution as a normal distribution, meaning that when you made that distribution, you were at least age 59 and a half or older. So let's talk about why cashing out a IRA is not a good idea. Well, first, IRAs are designed for long-term retirement growth. With the Social Security projections indicating potential trust fund depletion by the mid to late 2030s, personal retirement savings will become even more important. So when you cash out your IRA, you lose tax deferred or tax-free compounding. You also reduce your future retirement income. You may owe significant taxes and penalties, especially if you are in a high income tax bracket. And you end up permanently removing assets from protected retirement status. We're talking about bankruptcy protection. IRAs are afforded bankruptcy protection up to a certain threshold. And we've actually performed a webinar on that topic in the past. So if you subscribe to our YouTube channel, you can access those past webinars. So in most cases, cashing out an IRA should be a last resort. So from an alternative strategy, instead of taking a distribution from your IRA or self-directed IRA, if you are self-employed, then there may be a better strategy. So instead of cashing out your IRA, consider opening a self-directed solo 401k plan, provided that you meet the eligibility requirements, which means that you're self-employed, you don't have any full-time W-2 employees in your business other than your spouse, and of course you have earned income from self-employment activity. This will allow you to establish a solo 401k, and as an alternative to taking a distribution from that IRA, you can actually take a solo 401k participant loan instead. Let's talk about the solo 401k participant loan rules. But first, let's talk about how you would transfer that IRA to that solo 401k plan. So you can transfer pre-tax IRA funds, now Roth IRA funds. The Roth IRA regulations currently do not allow for the transfer of a Roth IRA, even a self-directed Roth IRA, to a solo 401k, even if it's a self-directed solo 401k plan. So that's a Roth IRA restriction. Congress, through the years, has introduced bills to try to change that rule. And there's hope that maybe the next Secure Act 3.0 will provide legislation that will allow for the transfer of Roth IRAs to a Roth solo 401k plan. But unfortunately, the rules currently do not allow for it. But you are able to transfer traditional IRAs to the self-directed solo 401k plan through a direct rollover. And once you directly roll over or transfer those self-directed IRA funds to the solo 401k plan, once they're transferred to the solo 401k, the funds become part of your solo 401k, and therefore they're no longer considered IRA funds. So now they're subject to the solo 401k regulations. So no taxes are going to be triggered when you transfer that self-directed IRA to the solo 401k plan. There's no limit on the amount that you can transfer from that self-directed IRA. And of course, neither taxes nor penalties will apply. And once you've transferred those self-directed IRA funds to the solo 401k plan, you can process a solo 401k participant loan. Let's talk about those solo 401k participant loan regulations. So unlike IRAs, solo 401k plans allow for participant loans. And of course, you have to make sure that you open a solo 401k plan that allows for those solo 401k participant loans. So if your plan allows for loans, such as a properly structured plan through my solo 401k financial, whose plan allows for solo 401k participant loans, then you can borrow. You can borrow up to 50% of your account balance for a maximum of $50,000. So the key advantages of processing a solo 401k participant loan versus processing a distribution from an IRA is that no taxes apply as long as you pay that loan back. Also, a 10% penalty does not apply. and you actually pay back yourself indirectly because the payments, including the interest, go back into your own solo 401k plan. So the funds remain within that retirement plan. So this strategy allows you to access liquidity without permanently damaging your retirement savings. So again, an important note is that not all solo 401k plans allow for participant loans. You must use a plan document that specifically permits loans. And again, providers like my solo 401k Financial offer plan documents designed to include this loan feature. As far as more information about the solo 401k participant loan rules, let's take a look at some of these items here. So when you borrow from your solo 401k plan, you have to make sure that you have the proper solo 401k participant loan documents prepared, and we prepare those here with my solo 401k Financial at no additional cost for our clients. And what's great about the solo 401k participant loan is that it does not impact your personal credit. So there's no credit check that needs to be performed. And you're borrowing from your own solo 401k plan, so you're paying your own plan back. So obviously you have to have enough funds in that solo 401k plan in order to borrow the maximum of $50,000. So if you have at least $100,000 in your solo 401k, you can borrow the maximum amount of $50,000. And then if, let's say that you and your spouse are both self-employed in the same business, then you can both participate in that solo 401k plan, and you can each borrow 50% of your respective funds in that solo 401k plan for a total of $100,000. So if you have $100,000 in a self-directed IRA, that can be transferred to the solo 401k. If your wife also has $100,000 in a self-directed IRA, her self-directed IRA funds can also be transferred to the same solo 401k plan, and then you would each be able to borrow $50,000 from that solo 401k plan for a total of $100,000. You can use those proceeds however you wish. Now, if you want to use those proceeds towards the purchase of your primary residence, then you can borrow for 15 years, even 30 years. So you would pay that loan back over a 15-year or 30-year period, consisting of fixed payments over that term, made up of principal and interest. If the proceeds are not going to be used towards the purchase of your primary residence, then the maximum loan period is 5 years. So you would pay that loan back over a 5-year period, either monthly or quarterly, and they're all scheduled payments. Okay. We already talked about the solo 401k eligibility requirements. Now, if this information is helping you feel more confident about your future, we would really appreciate it if you took a few moments to like and subscribe to our YouTube channel and like us across the various social platforms, as this helps other solopreneurs and self-directed IRA participants to find the information more easily. So some final thoughts. Yes, you can cash out your self-directed IRA, but doing so often means federal income taxes, possible state income taxes, a 10% early withdrawal penalty if under age 59 and a half, loss of future compounding. So before liquidating any retirement assets, including your self-directed IRA, consider in-kind distribution implications, the Roth IRA qualification rules, the required Form 1099-R reporting and consequences, and the alternative, that is utilizing a solo 401k so that you can process a solo 401k participant loan. So your IRA is meant to fund your retirement, not solve short-term liquidity needs. So with the uncertain future of the Social Security Fund, preserving and strategically leveraging retirement assets has never been more important. Okay, looks like we've come to the end of our session here. I don't see any questions. Looks like it's a quiet Friday. So that's it for today's self-directed IRA and solo 401k session. Thank you so much for investing your time with us. We know your time is valuable, but we feel that your future depends on it. So if you haven't yet, please like and subscribe to our YouTube channel and like us across the various social platforms. We'll actually be back here again in a couple hours with more crucial content. Until then, have a good rest of the day.